Let's discuss the married put to speculate in stock markets. This is when an investor buys a put option for an equivalent number of shares they own in the underlying stock. It's a way of ensuring the value of the investor's holdings. What is the primary objective of the married put strategy in stock options trading? The objective of using a butterfly spread in stock options trading is profiting from minimal price movement in the underlying asset. This strategy involves combining both bull and bear spreads with the same expiration date, using either calls or puts to capitalize on a stock that is expected to have little to no significant price change. The primary goal of a married put strategy is to hedge or insure an investor's stock holdings against potential declines in value. By purchasing a put option for an equivalent number of shares they own, the investor secures the right to sell their stock at a predetermined price, thus limiting potential losses if the stock price falls. This strategy is focused on risk management and capital preservation, rather than on income generation or speculation. How does the married put strategy perform under different market conditions? The butterfly spread strategy is ideal in low volatility, stable markets. It performs best when the underlying asset's price remains close to the middle strike price of the spread. In contrast, in highly volatile or significantly trending markets, the effectiveness of the butterfly spread decreases. Married puts are particularly effective in uncertain or bearish market conditions where the risk of a decline in stock value is high. This strategy provides a safety net, allowing investors to retain their stock positions while being protected from significant downside risks. It may be less necessary in bullish markets where the likelihood of a stock price drop is lower. What risk is associated with the married put strategy? The risks involved in a butterfly spread strategy are limited and defined. The maximum loss is restricted to the net cost of entering the trade, which is the cost of buying the spreads. This limited risk makes the butterfly spread an attractive strategy for traders seeking to control potential losses. The risk in a married put strategy is limited to the cost of the put option premium. If the stock price does not fall below the strike price of the put, the investor will incur the cost of the option without any offsetting benefit. However, the potential loss on the stock holding itself is capped at the put option's strike price, effectively limiting the downside risk. What potential rewards can be expected from a married put? The rewards from a butterfly spread include capped gains within a specific price range. The maximum profit occurs if the underlying asset's price is exactly at the middle strike price at expiration. The profit potential is the difference between the strike prices minus the net cost of entering the trade. The primary benefit of a married put is the protection it offers against significant losses, while still allowing for capital appreciation if the stock price increases. The best case scenario is the stock price rising, rendering the put option unnecessary, with the investor benefiting from the stock's appreciation. However, the cost of the put option will reduce the overall profit. What are the key implementation steps for a married put strategy in stock options trading? Key steps in implementing a butterfly spread include selecting the appropriate strike prices and expiration date for the options involved, ensuring the middle strike is aligned with the expected price of the underlying asset at expiration, and monitoring the market to manage the position effectively. The trader needs to carefully plan entry and exit strategies to maximize the potential of the trade. Implementing a married put strategy involves owning or purchasing a stock that the investor wishes to protect, buying a put option with a strike price at or slightly below the current stock price. The expiration date of the put should align with the period during which protection is desired. Paying the premium required for the put option, which is the cost of the protection. Monitoring the stock and the put option, particularly as the expiration date approaches or if market conditions change significantly. Deciding whether to exercise the put option if the stock price falls below the strike price, or to let it expire if the stock price remains stable or increases. A married put strategy in stock investing offers investors a way to protect their stock investments against significant declines while maintaining the potential for upside gains. It requires balancing the cost of the put option against the value of downside protection, making it a prudent strategy for risk-averse investors or in times of market uncertainty. The collar strategy to speculate in stock markets. A collar strategy involves holding the underlying stock, buying a protective put, and selling a covered call. It's a way to protect against large losses, but also caps potential gains. What is the strategic goal of the collar strategy in stock options? The strategic goal of the collar strategy in stock options trading is balancing risk management with capped gains. This strategy involves holding the underlying asset, buying a put option to protect against downside risk, and selling a call option to offset the put's cost. It aims to provide downside protection while accepting a limit on the upside potential. The primary goal of a collar strategy is to protect stock investments from significant losses while capping potential gains. This is achieved by holding the underlying stock, buying a protective put option to limit downside risk, and selling a covered call option to offset the cost of the put, which in turn caps the upside potential. The strategy is primarily focused on hedging against market movements and preserving capital, rather than aggressive capital appreciation or income generation. How does the collar strategy adapt to changing market conditions? The collar strategy is suitable for moderately bullish or stable markets. It works well when modest price increases are expected. However, large gains are capped due to the sold call. In bearish markets, the put option provides protection, limiting the potential loss. A collar strategy is most effective in moderately bullish or stable market conditions. It is designed to provide downside protection in uncertain or slightly bearish markets while allowing for some capital appreciation. This strategy is less beneficial in strongly bullish markets, as the sold call option limits the potential upside. What is the risk profile for a collar strategy? The risk profile for a collar strategy involves limited downside with capped upside potential. The strategy ensures that losses do not exceed a certain level. It's set by the put strike price, but it also means that any gains beyond the call strike price will not benefit the investor. The collar strategy limits downside risk to the strike price of the protective put, minus the cost of the put and any gains from the call premium. The primary risk is that the stock's price increases significantly and the stock is called away due to the covered call, capping the potential gains. The investor's risk is balanced between the protection from the put and the limit on gains by the call. What are the potential rewards of using a collar? The potential rewards of using a collar include limited gains with downside protection. While the strategy limits the maximum profit that can be achieved due to the price paid for the call option, it provides a safety net against significant losses, making it a conservative strategy. The reward potential of a collar strategy is capped at the strike price of the covered call option. The best case scenario is the stock price increasing up to the call's strike price, allowing the investor to realize moderate gains while having downside protection. The cost of the put is often offset by the income from selling the call, but the overall profit potential is limited. What are the considerations for implementing a collar strategy in stock options trading? Key considerations for implementing a collar strategy include selecting appropriate strike prices and expiration dates for both the put and call options, ensuring they align with the investor's market expectations and risk tolerance. The strategy requires careful balancing of the cost of the put option with the income from the call option. Continuous monitoring of the stock and options prices is essential to adjust the strategy as market conditions change. Implementing a collar strategy involves holding shares of the underlying stock that the investor seeks to protect, buying a put option to set a floor for potential losses. The strike price of the put is typically at or below the current stock price. Selling a call option with a strike price above the current stock price, generating premium income that can offset the cost of the put. Choosing expiration dates that align with the investor's market outlook and risk tolerance. Monitoring the stock price and being aware of assignment risk on the call, especially if the stock price approaches or exceeds the call's strike price. Understanding the trade-offs between the cost of downside protection and the cap on potential gains. A collar strategy in stock investing is a conservative approach that balances downside protection with capped upside potential. It is particularly suitable for investors who are willing to forego some profit potential in exchange for reduced risk and greater peace of mind in uncertain or moderately bullish market conditions. Using the credit spread to speculate in stock markets. This involves selling an option, put or call, and buying a further out-of-the-money option of the same type. It generates income from the premium received, but has limited profit potential. What is the objective of using a credit spread in stock options trading? The objective of using a credit spread in stock options trading is generating income from option premiums with limited risk. This strategy involves simultaneously selling one option and buying another option of the same type, either calls or puts, but with a different strike price, resulting in a net credit to the trader's account. The primary goal of a credit spread strategy is to generate income through the premiums received from selling options. This involves selling either a put or a call option and buying a further out-of-the-money option of the same type, such as a put or call. The strategy is designed to capitalize on the premium differential between the sold and bought options, primarily focusing on income generation rather than capital appreciation. How does the credit spread strategy fare across various market conditions? The credit spread strategy can be effective in various market conditions depending on the type of spread used. A bull credit spread, which entails selling a lower strike call and buying a higher strike call, works well in rising markets, whereas a bear credit spread, which involves selling a higher strike put and buying a lower strike put, is suitable for declining markets. Credit spreads can be adapted to various market conditions. A call credit spread or a bear call spread is typically used in bearish or neutral market conditions, while a put credit spread or a bull put spread is effective in bullish or neutral conditions. The strategy is particularly useful in markets where the underlying asset is not expected to exhibit significant volatility beyond the strike prices of the options involved. What risks are involved in a credit spread strategy? The risks involved in a credit spread strategy include a limited maximum loss and profit potential. The maximum loss is the difference between the strike prices of the two options minus the net credit received, and the maximum profit is the initial credit received. The trader's risk is capped, but so is their profit potential. The risk in a credit spread is limited to the difference between the strike prices of the options minus the net premium received. This defines the maximum loss, which occurs if the market moves significantly against the position. However, the potential profit is also capped at the premium received for setting up the spread. What rewards can be expected from a credit spread? The rewards from a credit spread include income from premiums with capped gains. The trader earns the net premium received from setting up the spread, which is the maximum profit. This strategy aims to benefit from the time decay of options and the underlying asset's price movement in a favorable direction. The reward potential with a credit spread is the net premium received from the difference between the premiums of the sold and bought options. The best case scenario is where the underlying asset's price stays favorable relative to the strike prices, allowing the options to expire worthless, and the trader retains the full premium. However, the gains are limited to the initial premium received. What key steps should be considered when implementing a credit spread in stock options? Key steps in implementing a credit spread include choosing the right strike prices and expiration dates for both the sold and bought options, assessing market conditions to decide whether a bull or bear spread is more appropriate, and managing the trade to maximize the probability of keeping the premium received. Monitoring the underlying asset's price and being prepared to adjust the position as necessary are also important. To implement a credit spread strategy effectively, determine the market outlook to choose between a call or put credit spread. Select the appropriate strike prices for both the sold and bought options, ensuring the sold option is closer to the current market price. Choose options with the same expiration date to create the spread. Calculate the net premium received, which is the income from selling the spread, and understand the maximum potential loss and gain. Monitor the underlying asset's price movement and be prepared to manage the position, especially if the market moves towards the sold option's strike price. Be aware of assignment risk, particularly for the sold option as expiration approaches. A credit spread strategy in options trading requires careful selection of strike prices and a clear understanding of market direction. It offers a balance between income generation and risk management, making it a popular choice for traders seeking to profit from premium decay in a controlled risk environment.